Welcome to this Grattan Institute speed briefing on Grattan Institute's latest report, Super Savings, Practical Policies for Fairer Superannuation and a Stronger Budget. We're very grateful that you can be with us today. My name is Brendan Coates. I'm the Economic Policy Program Director at the Grattan Institute. And joining me is Joey Moloney, Senior Associate at Grattan and co-author on the report. We're joining you today from the lands of the Wurundjeri people of the Kulin Nation, and we pay our respects to the elders past, present and emerging. We also acknowledge and respect the traditional owners of the lands across Australia and recognise the continuing sovereignties of all Aboriginal and Torres Strait Islander nations. So today, in this speed briefing, over the course of 25 minutes, we're going to talk through our latest report on superannuation tax breaks that was released on Monday. I'll just share my screen now. We're also happy to take questions throughout the presentation. If you put them in the box, we will then get to them at the end of the presentation. Now, Joan, just confirming you can see those slides. Great. Thanks very much. So this latest report that we've published this week is about tax breaks inside superannuation. Now, tax breaks inside superannuation are large and they are very generous. And as we'll show today, we think that those tax breaks go beyond any plausible purpose for the superannuation system and that they should be reined in a fairer and more sustainable superannuation system that is more in line with any stated objective or plausible stated objective system. And also because we face a severe budget problem. The federal budget is facing deficits of $50 billion a year, 2% of GDP. Australia's population is ageing. We face big spending pressures in health, aged care, disability and defence. And super tax breaks should be one of the first things that the governments consider when they look to rein in that deficit and to put the budget on a more sustainable footing while meeting those long-term spending pressures. So what are tax breaks in super? They essentially mean that money saved into superannuation via contributions, as well as the earnings, the dividends, the interest and other returns on those savings, are taxed at much lower rates than if that income was saved outside of superannuation at full rates of personal income tax. Those tax breaks are costing us a lot. You know, by our estimate, they're costing around $45 billion a year. And they will soon, based on work by the 2021 Intergenerational Report, they will soon cost more than the age pension by as soon as 2036 and much more than the age pension as far out as 2060. Those concessions are also distributed in a way that largely benefit high-income earners. Now, high-income earners will always benefit from super tax breaks since they contribute more to superannuation as they earn more. But some of the concessions in particular give a larger break to high-income earners than they do to low-income earners. And so we estimate that about 68%, so just over 2/3 of the value of concessions, flows to the wealthiest 20% of Australians. And in fact, the wealthiest 10% of Australians are receiving a larger support from super tax breaks over their lifetime. This is projecting someone's retirement income from their working age as a young person today all the way through to their retirement years. They're expected to get a larger concession from tax breaks in blue on contributions and earnings than what many low-income earners, or as large as many low-income earners, are getting from the value of the age pension. Which is no surprise as why, when we think about the costs of the tax breaks in superannuation, they in fact aren't doing very much to reduce the value of age pension spending, because the largest value of them goes to the wealthiest 20% of Australians that really are unlikely to receive much or any in the way of the age pension over their working life and into retirement. And so you can see here from the retirement income review, the value of the tax breaks that go to people at different points in the earnings distribution in the red bars, compared to the value of the age pension savings that arise from those tax breaks. And then the black dots show the net effect. So superannuation tax concessions in particular are not doing very much to reduce the burden of the age pension on the federal budget. In fact, they're exacerbating the costs of an ageing population because they are such a large drain on federal government coffers. And when we look at those concessions and we compare them, for example, to the way that we tax other savings vehicles, superannuation is taxed very highly concessional compared to almost any other form of savings, including much more concessionally on average over time than investing in your own home. So this is showing you the real effective compounding tax rate on superannuation, noting that earnings on super are taxed and that those tax rates compound over time, compared to a world where you pay full marginal rates of tax on those contributions before they go into super, and then there was no tax paid on either the earnings or the withdrawals. So what is called an expenditure tax benchmark or a TEE benchmark. And against such a benchmark, you see other vehicles, domestic equities, foreign equities, and investment property are taxed positively compared to an expenditure tax benchmark, whereas superannuation is taxed highly concessionally against such a benchmark. So it just shows just how generously superannuation, particularly when those contributions come from pre-tax income, how concessionally that is taxed compared to other savings vehicles in Australia. And in fact, the benefit that people receive from tax concessions on superannuation, which boosts the value of their superannuation balances at retirement, what we're finding is that very little of that money is in fact being spent. So we know from the retirement income review, from Grattan's past work, that a lot of the value of savings, of retirement savings, is not spent in retirement. The typical retiree is essentially a net saver in retirement. And what that means is the value of those tax breaks that go into super, they're topping up the value of those super balances. And if those super balances are then never spent in retirement, then by definition, they're being passed on as bequests. And so superannuation is becoming, unfortunately, a taxpayer-funded inheritance scheme. Around $1 in $3 paid out of the super system by 2060 will be in the form of a bequest, which is up from about $1 in $5 today. And so this shows the need, the urgency of changing the way these concessions work. But if we step back before we think about how you would reform the system, we need to think about what are the rationales for why we offer these concessions. We know they're expensive. We know they're distributed unequally. But why do we offer them in the first place? And there are really three rationales given. And against all three, it's clear that the existing tax breaks are not well targeted against those purposes. So firstly, we offer tax breaks for superannuation because super savings are saved for a long period of time. And so we know that when we do tax the return to earnings, the return to super, like other returns to savings, it can have a compounding effect and lead to a higher effective tax break in the long term. It's like compound interest, but in reverse. But as we've seen from the previous slides, super tax breaks combine for a negative marginal effective tax break compared to an expenditure tax benchmark, which is a very concessionally taxed treatment of superannuation savings. Really, we shouldn't be aiming for anything more concessional than the expenditure tax benchmark, and there are good reasons why should we aim for less than the expenditure tax benchmark. Super tax breaks are notionally about encouraging additional savings, but what we see in the empirical evidence from Australia and around the world is they have very little impact on the amount that's saved. Most of the boost to savings for retirement from superannuation is because super is compulsory. We are forced to save more than 10% of our income each year. And the empirical evidence shows that when tax breaks are offered in Australia and around the world, they don't encourage additional saving. Instead, what they do is they tend to see higher wealth, higher income of people reallocate their existing savings into the more tax-preferred vehicle of superannuation, which is to say that superannuation tax breaks are used in many cases to support tax minimisation and tax planning. And finally, the third reason that's often put forward for why we should have a tax breaks on superannuation is that they're compensation for preservation, that we're locking up people's incomes for a long time, and that we should compensate people accordingly. What's interesting, though, is that low-income earners are much more likely to be affected or hurt by preservation than high-income earners. Low-income earners are under much more financial stress today while they're working. The extra super savings that come particularly from compulsory super, which boosts the super savings of low-income earners, largely leads to less age pension for many low-income earners in retirement because the age pension is means tested. So they give up their wages today. They get extra super savings in retirement. That reduces the value of their age pension. And as Grattan's past work has shown, many low-income earners are being forced to save for a higher standard of living in retirement than what they're enjoying while working. So all these reasons would suggest that we should be offering larger tax breaks per dollar contributed to super to low-income earners than we do to high-income earners. And unfortunately, Australia's system today, as we'll see, does the opposite. So how should contribution tax breaks be changed? Well, first of all, let's talk about how they're structured right now. So as I said before, the tax breaks in superannuation reflect the difference between the marginal tax rate that was applied to our income, and we see here the current income tax thresholds, and then what they'll be once the stage 3 tax cuts are fully implemented in 2024, compared to how superannuation is taxed. And most contributions are taxed at a rate of 15%, except for low-income earners who are taxed at a rate of 0% on their super contributions due to the low-income super tax offset, and high-income earners that are taxed at a 30% rate on their contributions because of Division 293 tax. And those policies combine to offer a 19% tax break on super for those at the bottom, a 15% tax break on super and those in the middle. But unfortunately, for many high-income earners, they offer a larger concession of 30%, 30 cents on the dollar, rather than the 15 cents that's been offered to middle-income earners. So how should these contribution tax breaks be changed? Well, we've recommended that the Division 293 tax, which taxes high-income earners' super contributions at 30 cents on the dollar, the threshold for that should be lowered from $250,000 a year to $220,000 a year, noting that this threshold includes the contributions themselves. So under our proposal, with the $220,000 a year threshold, essentially anyone with earning the top marginal tax rate of $200,000 from when the stage 3 tax cuts implemented would see a 10 percentage point discount on their contributions, because we would also raise that Division 293 tax rate from 30 to 35%. So then we would have a system where high-income earners get a 10 percentage point discount or tax break on their super contributions, middle-income earners get 15%, and low-income earners get 19%. Given that the personal income tax bracket for the 19% rate will also rise to $45,000 from $37,000, we should expand the list though. We should offer it to those between $37,000 and $45,000 a year. That has a cost, but it's a policy that, as part of a coherent system of super tax breaks should be implemented. But we would argue that should only happen once we've actually done other more urgent changes to the retirement income system, such as raising the rate of Commonwealth rent assistance and potentially also raising the rate of job seeker. So our policies to reform contributions tax breaks are to tighten the Division 293 tax, raising it to 35% with a $220,000 threshold would save $1.1 billion. All the savings would come from the wealthiest, frankly, not just 10% of taxpayers, really the wealthiest 5% of taxpayers in Australia. We would expand the listo at a cost of $530 million, but only once we've fixed other more urgent equity problems in the retirement income system. But we would also reduce the value of the annual cap on pre-tax contributions from $27,500 a year, that's the amount you contribute from pre-tax income, down to $20,000 a year. And that would save $1.6 billion. And the reason we would like to do that is because those contributions above $20,000 a year tend to be made on a voluntary basis rather than being compulsory contributions. And they tend to be being made by the wealthiest 2/3 of Australians at any age. And a lot of that looks to us like tax minimisation rather than genuine retirement saving. And so that would save another $1.6 billion a year, which would leave us with savings of $2.2 billion a year and more over time from curbing contributions tax breaks. Now I'm going to hand over to my colleague, Joey Moloney, who will talk through our other recommendations.
Thank you, Brendan. So I'm going to take you through our proposed changes to earnings tax breaks. Next slide, please, Brendan. So recall this chart from earlier showing the projected costs of the retirement income system out to 2060. And we noted earlier that super tax breaks are expected to overtake the cost of the age pension by the mid-2030s. I'll draw your attention to the second from the bottom line there, earnings tax breaks in particular. You can see that's the one doing the heavy lifting of the growing cost of total super tax breaks over time, to the point where by 2060, earnings tax breaks by themselves will almost cost as much as the age pension in its entirety. Next slide, please, Brendan. And on top of being unsustainable, earnings tax breaks are deeply unfair. one of the big drivers of the increasing costs of earnings tax breaks over time is the tax-free status of retirement earnings. So accumulation earnings are taxed at 15%, people who are still working. Once you hit the retirement stage, you can roll 1.7 million, soon to be 1.9 million, into a tax-free retirement account. The way that those tax breaks, those extra generous tax breaks, are allocated amongst current retirees are deeply unfair. So in 2019-20, someone who had above the then transfer balance cap of $1.6 million got average earnings tax breaks on their balances that could have funded more than 2 age pensions. Then on the other side, consider that half of current retirees don't actually have any super, so they get no benefit from this tax-free status of retirement earnings. Next slide, please, Brendan. So naturally, if tax-free retirement earnings are the most unsustainable and unfair feature of the way that we tax superannuation earnings, our solution is quite simple. Align the tax treatment between retirement earnings and accumulation earnings, which is to say tax retirement earnings at 15%. This would raise material revenue, about $5.3 to $7.3 billion on our estimates. And distributionally, 70% of those savings, at least 70%, probably more, would come from the top 20% of retirees, reflecting the unequal distribution of super balances among retirees. Now, taxing all retirement earnings at 15% is admittedly quite a large political ask. So we also explored some other options that may be more politically palatable, but wouldn't necessarily address the magnitude of the fairness and sustainability problems that we're staring down. So recall I said before, the transfer balance cap is the maximum amount a new retiree can roll into their tax-free retirement account. You could reduce that cap. If you reduce it to $500,000, you'd exclude all full rate pensioners. And if you reduced it to $1 million, you'd exclude all pensions, full rate and part rate. Now, that still produced material savings, just not in the same ballpark as taxing all retirement earnings at 15%. So $2.3 billion to $3.4 billion for a $500,000 transfer balance cap, $1.1 billion to $1.6 billion for a $1 million transfer balance cap. And similar to our preferred option, distributionally, the vast majority of the savings there are coming from retirees with already high incomes who are enjoying a comfortable retirement regardless of the generosity of their earnings tax breaks. Next slide, please, Brendan. So this is unpacking our preferred option of taxing all retirement earnings at 15%. I won't explain the difference between the no behavioural change and full behavioural change scenario here, but for people who are interested in the ins and outs of modelling assumptions, I'd encourage you to read the appendix of our report. The key point of this chart is that the average extra tax paid by retirees of different incomes really only rises materially for retirees with already high incomes if we tax their retirement earnings at 15%. So the key takeaway here is that this change, which would improve the fairness of super tax breaks and the sustainability of super tax breaks, wouldn't compromise anyone's comfortable retirement because high-income retirees are going to have a comfortable and dignified retirement regardless of the generosity of their earnings tax breaks. Next slide, please, Brendan. And the last thing we touched on in our report that I'm going to go through is a look at the government's recent proposal to tax the earnings on balances above $3 million at 30%. Next slide, please, Brendan. We think this threshold should be lowered to $2 million. This is a really, really good policy, I should say, directionally, in that there is no rationale for generous earnings tax breaks on those very high super balance accounts, particularly when you think about the fact that a lot of those high balance accounts don't get spent down in retirement. So we've got these generous earnings tax breaks that are not needed for comfortable retirement that are just going to end up propping up bequests to the next generation. This chart is showing you how skewed the distribution of super balances really is. If we think about people with more than $2 million in super, they're very few in number. In 2019-20, there was only about 80,000 of them, about 0.5% of people with super. But together, they held about $300 billion in super. That's as much as the total super assets of the combined balances of the bottom 11 million, 2/3 of Australians, that have less than $100,000 in super. Next slide, please, Brent. So just to recap, the government's policy is that from 2025, earnings on balances in excess of $3 million, that's an unindexed threshold, subject to an extra 15% tax that can be paid inside or outside of super. Treasury estimates that will raise about $2 billion in revenue once it's fully operational, impacting about 80,000 people by the time it's fully operational. So why do we think 2 million is a better threshold? Well, fundamentally, it better reduces taxpayer-subsidised instances. As I said before, earnings tax breaks on 2 to 3 million are not needed for a dignified retirement. This $2 million threshold would save the budget a further $1 billion, and it can be indexed straight away, being a more appropriate value. There's also some simplification benefits that I won't touch on now in the interest of time, but I'd encourage you to read the report if you're interested. Next slide, please, Brendan.
I think in the interest of time, we'll jump onto questions.
I think that's a great call. Okay. So I might start with some questions that came through the pre-questionnaire. The first question we have here is from Dean, that I'll throw to you, Brendan. Will this proposal be a factor in discouraging participants from pursuing higher paying roles or employment? Are there not better areas to focus on to increase effective taxation? So I think what this question is getting at, Brendan, is in terms of the efficiency of taxation, are our proposals the best available?
So I think we're in a world where the deficit is $50 billion a year. Yeah, I think in realistically, that deficit is actually, in fact, structurally larger than that. And I suspect we'll see a bit more of that acknowledgement in the budget. So superannuation is one of the things, and certainly if you think of a menu of options that would see the government collecting more revenue or reducing spending, it's at the top of our list or near the top of our list because so much of the value of those concessions is inconsistent with the purpose of the super system. You know, to provide income in retirement, to supplement or substitute for the age pension, which is broadly the objective put forward by both sides of politics in one form or another over the course of the last few years. So we expect there may be some small effects on disincentives to work, but I think what we see from the literature is that that doesn't have a huge impact on people's savings behaviour. I wouldn't expect it to have an enormous impact on people's incentives to work to achieve a higher income, because if they wanted to if they wanted to save more, the incentive is there now and they're not using that at the moment. So there are others that we should look at. We should certainly look at taxing resource rents more in Australia. You know, that's something that my colleague Daniel Wood will probably have more to say on in the coming days. But it's certainly something, this is one of a number of policies that we think need to change if we're going to put the budget on a more sustainable footing.
Thanks, Brendan. And I should say apologies in advance if we don't get to your question. We've got a lot and we are pushed for time. The next question came from Charles. He's asked, how likely is it that a first-term Labor government will look to implement large-scale super reform?
I'd expect that some of the policies that we've put on the table are things that an Albanese government could take to the next election, or, you know, I think in a more unlikely scenario that the coalition could have taken to an election, noting that the coalition did wind back some of the more excessive super tax breaks in 2016 in what was one of the real success stories of their term in Parliament. I think it's likely we could see changes to the Division 293 tax rate because that affects only a small number of people. We could see the tightening of those contribution caps. The reality is the government faces a big budget challenge and it's going to have to make some choices that are going to reduce that over time. And super, to me, is near the top of the list. The idea of taxing all super earnings at 15% is something where we are strongly encouraging both sides of politics to consider. But it is a more difficult reform and it may take longer for that to come through.
Thanks, Brendan. The next question is from Richard. He asked, do we support grandfathering increasing the retirement earnings tax to 15%?
In short answer, Richard, no, we don't. And the reason for that is because, you know, changing the tax rate on earnings is taxing future earnings at a higher rate. That is not any different from taxing, changing the tax rates that apply to personal income tax today that, you know, may affect the tax rate on an investment property or on shares that are held by someone today. If we grandfather those changes, you basically lift up that drawbridge and the cost of an ageing population will be fully passed through to younger generations. So we think that this isn't retrospective. We do think it is a reasonable ask. We're in a world now where only 1 in 6 retirees are paying any tax at all, income tax at all, and that's not a sustainable situation that we're in today.
Thanks, Brendan. That brings us to 12:25, so we might wrap up there. Thank you, everyone, for joining us. We hope that you get a chance to read the report and enjoy it, and we look forward to your future engagement with future Grattan events.